Welcome to the first video in the Accounting Fundamentals course of the Financial Modeling Fundamentals program. In this lesson, we're going to begin by going over the income statement of a company, which is one of the most important financial statements and something that you're always going to need to know when you're analyzing and modeling companies, and also in the course of investment banking and other finance interviews. Now, in this lesson, we're going to be using Apple's financial statements as inspiration for the income statement that we are going to be creating here. We are not going to follow them directly and copy everything directly because I want to focus on the concepts here as opposed to getting all the details in their financials reflected here. I want to really focus on teaching you the concepts and getting you to understand how the income statement works and some common items on there. If you pull up the handout that I've linked to right below this video called Apple Financial Statements, you can see Apple's income statement listed right here. I'm going to ignore the numbers over here on the right side for now and instead just focus on the items listed on the left and go down here and give you an idea of what each one of these means and then do a comparison and show you what a personal income statement for someone in the real world, some real person, not a company, might look like, and then use that to show you what an income statement for a company means by comparing and contrasting the two. So you see right here the major items of the income statement. We start with net sales at the top, meaning the total revenue for the company, how much in total they're selling. So in Apple's case, net sales might correspond to how many iPads they're selling times the price of all those iPads, plus how many iPhones they're selling times the price of all those iPhones, plus the number of iPods they're selling times the price of each iPod. And then you would add in the total number of computers and laptops they're selling times the prices of those computers and laptops. Now the cost of sales right here, also known as the cost of goods sold, corresponds to how much it actually costs to sell all those iPhones, iPads, and iPods, and other computers and laptops. So the cost to actually manufacture them and then ship and distribute them to the consumers who are buying them. The operating expenses here correspond to how much it costs to develop those items in the first place and then how much it costs to sell them. The distinction here is that cost of sales or cost of goods sold, as you sometimes see it, as is the case in our Excel file right here. The difference is that cost of goods sold corresponds to per unit expenses, whereas the operating expenses here correspond to items that cannot be linked directly to per unit production. So going back, we see the rest of the income statement right here, operating income, and then we have other income and expense, we have taxes, and then we have our net income, how much Apple is actually earning after taxes here. Now, once again, I have not followed this outline exactly with the income statement that you see in the Excel file right here. I just wanted to bring it up and show you Apple's income statement right there to show you the original inspiration for this and where some of the format and the layout for this financial statement is coming from. To jump back into this and to go into a real-world analogy now to explain the income statement in more detail, you can think of the revenue, also known as the net sales of a company or the net revenue of a company, as being similar to the salary and commissions, in this case, if you're a traveling salesperson. Now, obviously, not everyone is a traveling salesperson, so you're not always going to have commissions, but pretty much everyone in the world is going to be earning some type of salary, and the revenue is very, very similar to earning a salary or the total amount that you're making from your business or your job or whatever it is you're doing. Now, the travel and per client expenses here are very similar to cost of goods sold. These correspond to additional expenses that you're going to have as a result of earning income from your job. So in this case, for a traveling salesperson, the more they travel, the more that they can sell. And so this is going to be directly linked to how much in salary and commissions. For a salesperson, it's really going to be linked to the commissions part of that they're actually earning. Once you have the per unit expenses and then how much you're earning, you can figure out what the gross profit is. The gross profit simply means how much you're earning after these per unit expenses. So in the case of the traveling salesperson here, I'm going to take salary and commissions and then subtract travel and per client expenses, and we get to a gross profit of around $200,000 here for this traveling salesperson. Now, once you figured out the gross profit, you can go down to the personal operating expenses right here. Now, for a company, these might be things like researching and developing new products and then selling those new products, also general and administrative items like hiring bookkeepers, hiring accountants, hiring general staff for the company, anything that's not directly linked to how much money they're making. So cost of goods sold, anything that is directly linked to how much they're selling. Operating expenses for both a person and a company, anything that is not directly linked to that. So for a person, food might be a major expense, rent might be a major expense as well, although we're not going to include that here because we're assuming that this person actually owns his own house, so there's no rent here. Day-to-day transportation, so commuting for pleasure, commuting to get to work in the first place, anything that's not directly linked to making additional money, any type of necessary transportation here. And then entertainment and luxury, so going on vacation, paying for new clothes, anything like that would be considered a personal operating expense here. And again, for a company, the main items are researching and developing new products, and then selling those new products, and then also paying for staff to support those new products, anything that's not directly linked to selling individual items here. So for a person, an individual here, we can add up the total operating expenses. I'm going to press Alt equals in Excel to do that. We get the summation right there. And then we have a couple other items before we get to the after-tax income. So for a company, we have these two items, depreciation and stock-based compensation. And then for our personal income statement, we have this item, depreciation of house. What do these items mean? Well, depreciation simply means that property the company owns, or in this case, property that the person owns, is losing value over time. We reflect this on the income statement because depreciation is tax deductible. One of the rules for expenses that you list on the income statement is that these expenses must be tax deductible. Depreciation is tax deductible for both a person, an individual who owns houses, for example, and then also for a company that owns property, and the property, the plants or equipment that it owns is declining in value over time. Now, this analogy does not hold up 100% because on your personal income statement, any depreciation that you deduct most of the time in most developed countries, it can only be for depreciation of rental properties, so not a house you're living in, but rather a house you're renting out to someone. So the analogy does not hold up 100%. I realize that these details are a bit off, but I just want to introduce the concept here that you can have property that loses value in both real life and also for a company. Normally this is listed separately, although sometimes it can be embedded and included in operating expenses or even in cost of goods sold. But here we're going to look at it and assume that it is listed separately. Stock-based compensation, this one doesn't have a direct analogy for a person per se, but what it means is when a company, instead of paying employees salaries, as it would for general and administrative and R&D, for example, instead of paying those salaries in cash, it is paying its employees with stock instead. Either stock itself or by paying them options, giving them grants of options that they can later exercise. So it still shows up on the income statement because it's tax deductible, it counts as compensation, but it is not paid out in cash. So both of these are non-cash expenses that show up. They show up here because they're tax deductible, and so we want to reflect them on the income statement as a cost of operating the company and as a cost of doing business, but keep in mind that these are not true cash expenses. When the value of your house falls or the value of property you own falls, it's not literally taking money out of your bank account. All that's happening there is that over time the value of something is falling. So it is counted as an expense, but it is not actually reducing the amount of cash that you have. So once you take into account all these different expenses, for the personal operating income here, I'm going to enter equals and then go up and take our gross profit. We subtract our operating expenses, and then we subtract any non-cash expenses like depreciation or stock-based compensation, for example. So that gets us our personal operating income, roughly how much we're earning either as an individual or as a business from our business operations. Now once we have that, that gives us some important information, but we also may have some other sources of income or other sources of expenses here. Examples on a personal level might be savings account interest. So maybe, for example, you have a lot of savings in an ING Direct account or another type of savings account at your bank and you're earning interest on that. That's what would show up after you list your core business operating income for both an individual and for a company. why does it show up here on the income statement? The reason it shows up here is because, again, it's going to affect your tax situation. If you earn interest, you're going to have to pay taxes on that interest. If you pay interest, you're going to save taxes because that interest is tax deductible. And we see that situation right here, the mortgage interest expense. So in this case, our traveling salesperson actually owns his own house because he has the depreciation of the house right here. And he's also paying interest on the mortgage for that house, and that is tax deductible, so it shows up here on the income statement. For a company, it's much the same, and if they're paying out interest expense on debt that they have or any type of credit line, debt, anything like that, it's going to be tax deductible and it's going to show up on the income statement. Note that, for example, if a company raises debt, so if it takes out additional debt or if it pays back debt, that does not show up on the income statement. The reason is because neither of those affects the tax situation. With debt, mortgages, anything like that, the only impact they have on your taxes is how much in interest you're paying on them. The actual debt itself, taking it out, paying it off, does not affect your tax situation. Only the interest expense affects how much you're paying in taxes, so that's why this is the only part that shows up on the income statement. In addition to interest, you could also have other income or expense, really anything that's coming from something that's not related to your core business operations. So for an individual, this might be income from a side business. So let's say that this traveling salesperson also has a side business providing consulting services to high school students who want to get into top colleges. Any income from that side business would show up right here. He's still going to have to pay taxes on it, so it still shows up on the income statement, but it's not really a core part of his salary, so we're not including it under revenue or under salary and commissions here. Instead, we're listing it as something separate that he still has to pay taxes on, but which is not core to what he spends most of his time doing. And it's the same for a company. Any source of income or expense from something that is not core to its business, any miscellaneous income or expenses like that would show up right here. They're still paying taxes or possibly saving taxes on them, but it's not considered part of the company's revenue, so it's not listed under revenue right here. So once we have all these in place, we can add up and figure out what our personal pre-tax income is. So I'm going to press Alt equals again, and we get to 105 right here. And then once we have that, we can figure out how much we're actually paying in taxes and then get to our after-tax income. Now, this is one part, if you scroll over here, where the analogy breaks down. The problem is that for a company, when a company is paying taxes and determining its income tax provision, it can deduct items like research and development, general and administrative, really anything that's on this income statement it can deduct. Depreciation, stock-based comp, interest expense, other expense, and so on. But for a person in real life, you cannot deduct food and normal living expenses like this. You can deduct depreciation and some of these other interest line items here. Of course, depreciation, as I mentioned before, technically has to be for a property that you rent out as opposed to something you live in. But the analogy does not hold up exactly here. And so the reason this person is paying so much in income taxes is because this income tax number is based off of their salary and commissions, really their gross profit here, after they pay these business expenses. It's based off of this 200,000 gross profit number, and so that's why the income taxes here are so high. So the analogy does not hold up exactly, because for a company, when they determine their income tax provision, they are actually able to deduct all these expenses, whereas an individual is not. So the analogy doesn't hold up 100%, but that is the rough idea here, that for both an individual and for a business, you have all these different expenses, and then you pay taxes on the end based roughly on how much you earned. So in this case, the after-tax income, we are going to take our personal pre-tax income here and then subtract our income taxes, so we get to 15 for our after-tax income. So overall, this traveling salesperson is not making too much money here. He has income of $250,000 and income after business expenses, after cost of goods sold here of $200,000. But overall, he's not making that much, primarily because the taxes are so high. So this person is probably in a country like the US or the UK where taxes are extremely high, and that's why his take-home pay is not particularly high. Now, over here on our company's income statement, Apple here, it's pretty similar. The net income here would simply be the pre-tax income minus the income tax provision, and that's what gets us to that. And then we have one additional line item here, earnings per share. That is simply the net income divided by the shares outstanding, public companies like Apple have many shareholders, and those shareholders expect to earn some kind of profit on their investment in the company. So the earnings per share is a rough metric of how much in profit they might expect to earn off of their investment. And to get that, you simply divide the net income by the shares outstanding right here, and that gets you to your earnings per share. So that's how the income statement for a company like Apple might look, and then how the income statement for a person, the traveling salesperson here, might look. A couple other rules and rules of thumb I want to go over right here. Just to recap, for the income statement, the key points are that the revenue and expenses are over a period of time, 1 year, 1 quarter, 1 month, something like that. So just as when you file your personal income taxes to the government, for example, you're reporting what you earned and paid in expenses over a period of time, it's the same for a company. It's never a snapshot. The income statement is always over a period of time. And it shows the total sales all the way down to the after-tax profit. It is not necessarily cash, revenue, and expenses, just anything that corresponds to the period that you're analyzing. So, perfect example right here, depreciation, stock-based compensation. Neither of these is a cash expense, but they're both tax deductible, and they both correspond to the specific period that we're looking at here, which is why they show up on the income statement. Likewise, for revenue, this entire amount may not be collected in cash by you, so even if you record $200 million in revenue, you may not actually collect all that much in cash. This is just how much you sold, but those customers may not have actually paid you 100% in cash yet. So this is how much you sold, but you may not have actually received $200 million in cash yet. I've also gotten some questions on when an expense should be on the income statement versus when expenses should not be on the income statement. Generally, there are 2 criteria that it needs to meet. First off, you have to be paying for something that lasts for 1 year or less, and then that expense has to be tax deductible. So, as a few examples here, debt interest is tax deductible, and it corresponds to something in the current period, so it shows up on the income statement. But if you're repaying that debt, as I mentioned before, so let's say that you've taken out student loans, for example, and you pay the interest, and then you also pay part of the principal on those loans back, that would not show up on your personal income statement because repaying the principal is not tax deductible. Only the interest portion is tax deductible, the same for both individuals and for companies. The debt is also going to last for many years, so it's not going to show up on the income statement. And then when you're buying a house, the depreciation is tax deductible and it corresponds to the value loss in a certain period. So when your house depreciates by, say, $20,000 here, that corresponds to something that happens in that specific period. So it shows up on the income statement. But if you buy a house, that is not going to show up on the income statement. And if a company buys property, that's not going to show up on the income statement. The reason is that if you buy a house for, say, $500,000, that's going to last for many, many years, maybe 20 or 30 years. It's the same if you buy a car, for example. That's also not going to show up on your personal income statement because it's good for many years into the future. So that's a brief explanation of why certain expenses would show up on the income statement and why certain expenses would not show up on the income statement. For your exercise now, what I want you to do is go through this and fill out the income statement for Apple here. I already have the traveling salesperson income statement filled out over here on the right-hand side. What I want you to do is to go over to Apple's income statement and fill out all these formulas. So get to their gross profit, their total operating expenses, then get to their operating income, their pre-tax income, net income, and then finally earnings per share. So pause this video right now, give it a shot yourself, and then if you get stuck or you have questions or you're confused about something, you can unpause the video and then we'll walk through it together and I'll show you exactly how to fill out the rest of this income statement. Okay, good. So here's what you do to fill out this income statement. For gross profit, remember that this is simply revenue minus cost of goods sold. So we get $150 million in gross profit. For total operating expenses, what we can do here is simply add up research and development and then general and administrative. I'm going to press Alt equals the shortcut in Excel to auto sum these. For operating income, remember that what we do for operating income is we take our gross profit, then we subtract operating expenses, And we also subtract any non-cash expenses that show up on the income statement, depreciation and stock-based compensation here. For pre-tax income, we want to take our operating income and then add in any miscellaneous income or expense and interest income and expense. So on the personal side, this might be savings account interest, mortgage interest expense, income from side business. For a company, similarly, it might be interest income or expense and then other income or expense. I can press Alt equals again in Excel to add these up. And then for the net income here, we're going to take our pre-tax income, subtract the income tax provision, we get to 33. And then for earnings per share, we're going to take our net income and divide by the shares outstanding. So we get to 33 cents per share here. We have 100 million shares outstanding, so each of those 100 million individual shareholders might be entitled to receive 33 cents per share here in terms of their expectations. Now, as we'll see later on, that's not exactly true, and what they actually get can often be significantly different from this number, but for now, that's just one way you can think about this and one way you can think about the concept of earnings per share. So that is a quick overview of the income statement and how what we did here corresponds to what an income statement in the real world for an actual person would look like. Again, we did not follow Apple's own financial statements and their own income statement exactly. The reason is because I want to teach you some concepts that are not included here, so we are going to diverge from this. We are going to use our own numbers for learning purposes here. We're going to follow their general outline for the other statements as well, but we're not going to stick to it 100% because I want to show you things that are not included in their statements and focus on the concepts as opposed to all the nitty-gritty details and the numbers in their financial statements. So now you understand the concept of the income statement, what types of revenue and expenses actually show up here, what it means, and how to actually go through and calculate all the relevant numbers from revenue down to net income at the end. Coming up in the next lesson, we're going to start getting into the balance sheet of Apple and then compare it once again to a personal balance sheet, and you'll see how the two compare, how the two differ, and what some of the key items there actually mean.